Very good evening, ladies and gentlemen. Welcome to yet another interesting, informative webinar on the issues in capital gains. I think this is the most wanted topic, and we have a wonderful speaker for the day. Before that, we have our Vice Chairman of the Direct Tax Committee of ICAI joining us to welcome you all. Kota S. Srinivas. So CA Kota S. Srinivas is a BCom graduate from Bangalore University, a fellow member of the Institute of Chartered Accountants of India, and also a fellow member of the Institute of Cost and Works Accountant of India. He served the institute for over 2 decades, starting from his student time till becoming a chairman of the SARC and today a Central Council member. So during his tenure at Bangalore branch of SARC of ICAI, he served in all the positions. He was the chairman of the Bangalore branch. During his chairmanship, he started distributing bags to CA students, and so far 25,000 students have been benefited by this initiative. And during this year, the branch was adjudged as the best branch of SARC of ICAI. As a regional council member, he served from 2010 to 2019. He was the chairman of the SARC during the year 2017-18. CA Kota S. Srinivas, a member of SARC, has brought in many initiatives which include conducting ARRC on international taxation, and is successful in conducting 5 ARRCs on international taxation. He organized regional level interstate cricket tournament for members, a very such interesting initiative. He prepared a concept paper on coaching classes as chairman of Academic Advisory Group. He was instrumental in developing digital project for SARC, improvised the IVR system for members and students, and is made available in 6 languages. In infrastructure development of SARC was undertaken. In fact, like this took away the major complaint of people not answering the phone at SARC. That was his wonderful initiative. He conducted around 1,000 hours of CP programs at SARC during the year 2017, first of its kind, actually. Presented papers in various study circles, meetings, workshops, seminars, etc. He is a visiting faculty at the ICAI Bangalore, authored a book named CA Referencer for Chartered Accountants, which was released by Bangalore branch of ICAI as a study circle series booklet. He is also a life member of the Karnataka State Chartered Accountants Association, life member of Bombay Chartered Accountants Society, founder of Group Dynamics in a study group on international taxation, Bangalore and Chennai. He is organized like various WhatsApp group connecting members in terms of knowledge sharing, and also a CARES group to help members in terms of the pandemic, oxygen concentrators, and also a passionate person for yoga for members. He has organized various yoga classes for the benefit of members and their families during lockdown to maintain immunity. A very, very active, vibrant personality. And he is fondly known as Think Differently and Act Perfectly. May I now request CA Kota S. Srinivas to welcome the gathering for this wonderful session. Over to you, sir. Okay. So here's a very warm welcome. The chairman and the vice chairman of the Direct Tax Committee will be joining us any time in the session, during the session. I shall now introduce our speaker for the day, CATG Suresh, the most wanted teacher, a superstar in South India, to say so. He's graduated commerce from Vivekananda College, a chartered accountant, cost management accountant, and a company secretary as well. He has represented his expertise in representing clients before assessing officers, Commissioner of Income Tax Appeals, Income Tax Appellate Tribunal, and he's providing consultancy on various wide range of issues in domestic and international taxation to corporate clients. Academically, he has contributed a lot. He has over 35 years of teaching experience in domestic taxation, international taxation, financial management, cost accounting, and financial accounting. He is a visiting faculty associated with ICAI, ICMI, MAI, ICSI, and a member of Academic Council in leading colleges in Chennai. He is also a mentor to thousands of students pursuing CA, CMA, and CS courses. And he's been a training regular faculty member in RTI Chennai, which conducts training for income tax officials. And he's also accredited with the national recognition, winner of National Award from the Capital Foundation Society, New Delhi, presented by the Union Law Minister. He is instrumental in producing many rank holders and qualified professionals in CA, CMA, and CS exams. He's also an author authored several influential books and articles on taxation and finance, including Simplified Approach to Direct Tax Laws. I think this is what the Ministry of Finance is looking at now. Simplified Approach to Taxation, published by CCH. Capital Gains Tax, Master Guide to Income Tax, paper present, and he's presented a lot of papers in various conferences. He's been the Direct Tax Committee of SICI, past chairman on in International Fiscal Association, and he's actively involved in various committees of ICI, including the Women and Young Members Empowerment Committee and the Direct Tax Committee. He's also interested in the general community and academic service. He's an executive committee member, honorary member of the PS Educational Society, which operates several prominent schools in Chennai and Kanchipuram. He is an academic council member in leading colleges, contributing curriculum development and academic excellence. CATG Suresh is recognized for his exceptional contributions to both the professional and academic spheres, leaving a lasting impact on the field of taxation and the future of finance professionals. Welcome, sir. And we have Kota Srinivas, Central Council member and Vice Chairman of the Direct Tax Committee, to welcome you all.
Hello. Am I audible?
Yes, sir. Yes, sir.
Yeah. So, good evening.
Yes, sir. Yes, sir. Audible.
Good evening to all of you. Let me first welcome CATG Suresh, the speaker for the day, and also CA Subhashini Ganapati, the moderator for this particular webinar. Members, I also welcome each and every one of you, and also the secretary and other staff members of DTC who are present here. First of all, let me reiterate that DTC is conducting these webinars every Thursday. One Thursday we do on direct taxes, and another Thursday we do on international taxation. And today we have a topic on direct taxes, namely intricacies under the capital gains taxation as such. So we have a renowned speaker, as you have heard the introduction of today's speaker, TG Suresh. Fondly is also known as CG Suresh because one of his better topic is capital gains. Instead of TG, people in Chennai would have changed his name as CG Suresh also. We call him as CG Suresh, also capital gains Suresh. Of course, a lot of things he has been into practice for more than 3 decades, and is teaching. He's also a faculty, and he has trained and shaped the careers of more than 1,000 and odd students in the southern region, and more so in Chennai, who have qualified as chartered accountants. And he is a person who keeps coming to the institute at a very short notice, and also our invitations, both at Regional Council Chennai and all the branches of the southern region and across the country. When I requested him, he readily accepted in spite of his busy schedule, because this September works will be there. So he had come and is addressing all of us for the next 1.5 to 2 hours as such. And as per the activities of DTC, our chairman used to tell every week. So today, because of some prior occupation, he is unable to join this particular webinar. Our chairman, CA Piyush Chajat. Only to tell you a few activities of DTC. Of course, we have brought out the implementation guide on revision in Form 3CD and Form 3CEB, guidance note on report of audit under Section 12A or 1026 of the Income Tax Act 1961. Since there were not many changes in the Act, so we have not brought the guidance note on entire 3CD as such. So only we have brought implementation guide on revision. Apart from this, as usual, we do a lot of other programs, and of course we are given the pre-budget memorandum and also post-budget memorandum to the government for this particular budget. And we have got certain courses on UAE corporate taxation. I request members to make use of it and also join those courses that has been conducted physically in India also, and also in diploma on international taxation. Many people will keep asking, you would like to do that diploma in international taxation. If more and more people are interested, you can just log into DTC website and express your interest, so that if we get a sizable number, maybe 30 to 40, we can organize this diploma in other parts of the country as such. So once again, I welcome all of you, and we wish that you get more knowledge, more enriched about some of the intricacies of capital gains. Of course, budget after budget, I think some simplification of the law is happening. And Finance Minister has said in next 6 months he will bring a new code where it will be much more simplified. Still, there will be some intricacies which Suresh sir will take through and explain to all of us. Thank you, and once again, welcome the speaker for the day.
Thank you so much, sir. So kind of you. Over to TG Suresh, sir, for his session. Look forward to hearing it.
Thank you. Hello?
Yes, sir,
Yeah.
you're audible, sir.
Yeah. The screen visible?
Yes, the presentation is visible.
Thank you, Potaji. Thank you, Subhashini, for the wonderful introduction. It's always a pleasure to address the members and also in the process enrich myself. It's more about, like, say, always understood my 35 years. The learning always happens only when you make a presentation. So that's why whenever somebody asks me to talk, I really take it because that just in fact, last week I spoke on a very interesting topic on taxation and artificial intelligence, and again under the ages of ICI only. So so therefore I always try to jump because that gives you a lot of opportunity to go in depth into the subject. So therefore I thank the Institute for giving me the opportunity and for the Direct Tax Committee. So for having me in this session. I don't know whether I have the time to run through all, and this is what I planned for today's session. The implications of changes made by the Finance Act number 2 of 2024 on the real estate transactions, the shares and securities. A very unnoticed amendment in section 47 clause 3. And of course, the buyback, which has been widely talked about. And of course, my most favorite topic, I don't know whether we'll have the time to do it. A very interesting interplay between 50C, 56(2), 10, and 49(4). We'll just try to find out whether we can run through all, subject to the time availability. So on 23rd July 2024, I don't know, all of us have been left either for a surprise or a bit of a shock. As the Vice Chairman is mentioning, the opening remarks of the Finance Minister was the entire act is going to be simplified in 6 months' time. And as a preamble to that, the simplification is made in capital gains. The simplification is made to some extent in charitable trust. Simplification is made in TDS in terms of the rates. And of course, we are back to the old block assessment. So these are some of the steps you mentioned. This is a trailer. So sometimes, like simplification always sometimes, results in unintended complications. So possibly the intention is good, but however, that might result in a little bit more complexity than what possibly you would have imagined. So if you take it was a very, very surprise move when they decided to take out the indexation benefit for all long-term capital assets effective from 23rd July 2024. But again, I would like to reiterate the provisions relating to indexation has not been restored at all. It's not been restored. When the bill was passed, when there was an amendment was made, so though there is an impression created that indexation benefit has been restored, which is not the case. If the changes have been made only in section 112, and therefore the indexation on or after 23rd July 2024 remains gone. So therefore, as we go past, we will get to know about that very important change, because normally when we hear that indexation has already been restored, at least for individual nature, which is not the case. So that's what I said. What looks like a little bit of a simplification, when you go to the fine print, it becomes a little bit complicated. Now, before we go to it, it's always better for us to go back to the history and just find out why these things were given and what is the necessity for this change as far as the government is concerned. Now, normally when there is a long-term capital gains, So you always have an intention to hold it for a longer period of time. Obviously, what you can buy 10 years before for 100 rupees, you cannot buy the same amount for 100 rupees today. So therefore, when you are trying to hold an asset for a longer period of time, obviously all of us as a student of economics also in our foundation and I'm an intermediate when I was student was an intermediate also. There is a benefit needs to be provided for the same. So up to assessment year 92, 93, we had a very simple system of providing the benefit by way of a standard deduction. So at the rate of 50% or 60%, depending upon the type of capital asset. Of course, first 15,000, you got 100% deduction. 15,000, 92, 93, the big amount. So you get 100% deduction straight. If my long-term capital is 15,000, entire 15,000 is deducted. But if it is 16,000, and the 1,000 you will still get 50 or 60% standard deduction. Balance alone, I have to pay tax. And this is how the benefit is given for inflation. Basically, because of the inflation, this benefit is given in a more simple way. They gave like a standard deduction under section 48(2) of the Income Tax Act. But in assessment year 93, 94, this was changed. And the reason given, if you look at the memorandum, it was specified. In the scheme prior to 1/4/1992, a basic deduction of 15,000 and a fixed percentage of the balance amount of capital gains was allowed as reduction to 48(2). The percentage depended on the nature of assets stated as assessing, but was unrelated to the length of the period of holding. So this deduction was intended to give a rough and a ready relief for inflation, to counteract bunching of profits and to exclude from the tax net capital gains, which were relatively small. A fair method of allowing relief for this factor is to link it to the period of holding. For this purpose, the cost of acquisition and cost of important asset are to be inflated to arrive at the indexed cost of acquisition, indexed cost of improvement, and then compute your long-term capital gains. Now, the intentions are very, very clear, very logical, because if I'm going to hold for a period of 24 months to become long-term, I get the same 50% reduction. Somebody holds for 24 years, you also get the same 50%. So this simple method of 50-60% reduction does not give the benefit of real inflation. And therefore, they said we are moving to a more logical system whereby we will produce index numbers. It was initially 81, 82. We'll start with the base year as 100, then 109, 106, and so on and so forth. Where on the base of actual inflation, there will be an adjustment made for the cost of acquisition, cost of improvement, and then the capital gains will be computed. So every year, index number notified, even for the current year, as all of you aware of, the index number notified is 363. And of course, the base year has been now shifted from 81, 82 to 2001 for 2001. So 2001 to base year of 100, and now we are 463. So therefore, there is a clear logical reason as to why we had the benefit of indexation. So come on 23rd July 2024. So the finance minister, as a part of simplification, she said that this is a trailer for simplification which is going to come in 6 months' time. The benefit of indexation provided with the second proviso to section 40 will not be available for transfers which are made on or after 23rd July 2024, which is nothing but the budget day. So on the day of the budget, fine, that's it. You don't get the benefit of indexation. Obviously, it's a bit retrospective because of the fact that in 2015, it's always been promised that we will never have a retrospective amendment. Therefore, a little bit of a surprise was there when this amendment was brought in. And of course, we have also not gone back to the old system of a standard deduction, which is, of course, is a very simplification, a rough but a very simple method. You subtract 50% or 60%. That also has not been done. But instead of 20% tax, the rate of tax has been reduced to 12.5%. We should bear in mind why the long-term capital gains was subject to tax at the rate of 20% in 93-94. In fact, the finance minister at the point of time used the term, it's a concessional rate. Now, why it was used as a concessional rate? If you go back to 93-94, the first slab rate was 20%. So ideally, what the government should have done, all successive governments, whenever the first slab rate is reduced, actually the tax on long-term capital gains tax should have also been reduced, because that was what the intent of the law. It was the law which is pronounced by the parliament, which includes members from all parties. It's the government of India's policy. Of course, we need to have a pretty logical reason to roll back something. So now, the concept of adjusting the cost of acquisition inflation has been removed. The standard deduction which was earlier there was also not there. So instead, there was a reduction from 20 to 12.5. The point we must bear in mind, as I mentioned earlier, that 20 itself was with the first slab rate at that point of time. And of course, obviously, all of us know 12.5 is not the first slab rate today. The relaxation was provided when the bill was passed in the parliament. Of course, I've got a lot of hue and cry on this proposal. And of course, the government heeded to the request. But when they made the request, what they tried to do was the relaxation for resident individual in respect of immovable property, which are acquired before 23rd July 2024, was given. It will be discussed in the subsequent slides. And of course, the reason given in the memorandum for this change was ease of computation of capital gains for the taxpayer and as well as the tax administration. So this is what the memorandum says. The reason why we are moving from the concept of indexation to no indexation with a reduced rate of tax. This will be more easier for both the taxpayer as well as the tax administration. We will see in the subsequent slides as to how it's going to work. Now, is that indexation actually been restored? Because a lot of times we hear from that the taxpayer has been given a choice to choose between 20% with indexation or 12.5% without indexation. That's what we colloquially hear. But the change was actually made in 112(1)(a). 112 provides for a tax rate for long-term capital gains, and 112(1)(a) alone has been changed, and 112(1)(a) is applicable only for individual or Hindu undivided family who are resident in India. So therefore, if the property is transferred after 23rd July 2024, for others, even this benefit is not available. But as far as individual nature of resident is concerned, is the indexation benefit restored to them? The answer is no, because if you look at the wordings of 112(1)(a), provided further that in case of a transfer of a long-term capital asset, being a land or building or both, which is acquired before 23rd July 2024, which is acquired before 23rd July 2024, where the income tax computed under item B, that is 12.5% without indexation, exceeds the income tax computed in accordance with the provisions of this Act as they stood immediately before that amendment by the Finance Act number 2, 2024, such excess shall be ignored. Such excess shall be ignored. So it is not a choice. In fact, even for the tax administration, this is a mandatory provision. The law very clearly says 12.5% without indexation. You compare the tax at the rate of 12.5% without indexation with 20% tax after indexation. Even if I have not claimed this benefit, department has to ignore the excess. There's no necessity for me to claim at all. This is a mandated law as far as the computation of tax payable. So therefore, if my tax after 20% indexation exceeds 12.5% without indexation, whether I claim this or not, such tax shall be ignored. So this is how it says. Therefore, there's no change has been made in section 48, second proviso. No change. So that means if you transfer asset on or after 23rd July 2024, you will not get the benefit of indexation even today. This provision has not restored that at all. You will not get the indexation. So if you acquire before 23rd July 2024, if you sell after 23rd July 2024, only for the purposes of calculation of tax, the indexation will be considered not for the purpose of computation of capital gains. How this will impact, that's what we're going to see in the subsequent slides. So let me just once again reiterate the implications. The benefit is available only to resident, individual, and HUF. The changes are made only in 112, and hence indexation benefit will not be available even after the amendment. And this benefit is, of course, is not going to be available to a partnership firm or LLP or companies, and of course, even to non-residents, because non-residents are not getting computation of capital gains under 112(1)(a). So therefore, even they will not get this benefit. Even if you are an NRA, they will not get this option. For them, it's only going to be 12.5% without indexation money. And also, this is also applicable only for land or buildings or both. For other long-term capital assets transferred on or after 23rd July 2024. The computational tax payable will be only under a new capital gains tax regime, because we are now used to a term of old tax regime, new tax regime. We can also call this as a new capital gains tax regime, if it can be called so. So it may be a very complicated term now. We did trying to simplify, but we are using NCGTR. Of course, people in Delhi, of course, because you are used to NCR and all. So of course, for you, a little bit more easier for you. So now, so how this is going to impact? We'll just see a few scenarios here. Now, it's a very, very interesting, very smart move. So on one side, the general public feels they got the same benefit as it was before. But when you get into the section, which is not the case. So therefore, you have the sense of, yes, I thought and got it, but have you really got it in total? Let's see with some of the examples. Now, I'll just take one example where you have acquired a property in 2001-2. So the first is on the basis of new capital gains tax regime, how much tax you will get. In old capital gains tax regime, how much tax you will get. And what will be your tax payable if you're an individual or HUF resident in India after this amendment. So I've taken 100 in the first case, the cost of acquisition is 20, the long-term capital gains 80, tax at 12.5% will come to 10. So whether this computation is going to change, the answer is no. So only thing what you have to do is, in your total income computation, the computation will remain at 81 lead. So what does this amendment says? Now compute your tax payable based on the law which existed prior to this amendment, which is indexation of cost of acquisition. Therefore, that old cap tax regime, read it as indexed cost rather than as a cost of acquisition. 100, the cost of index cost is 72.6, long-term capital gains 27.4. 20% of that comes to 5.48. So what the amendment says, now the tax payable after this amendment comes to 10. The tax payable based on the law which existed before the amendment as on 23rd July 2024, which is indexation at 20% tax, that comes to 5.48. Therefore, there is an excess tax of 4.52. That 4.52 tax we will ignore. What if you put the taxes 10 and you are not calculate the tax, assuming that utility also misses that also for some reason? When the assessing officer processes a return, he has to calculate the taxes only at 5.48. He cannot come back and say, you are not after this and all. There's no question of any option. The law mandates that the tax as per the new tax regime is 10 and the old capital gains tax regime is 5.48. That means your tax will be only 5.48. So the question of you claiming, non-claiming does not arise. It's a mandatory provision. So that means because of this amendment, yes, it's a good amendment to that extent. You say 4.52. Had this amendment not been there, you have been forced to pay tax of 10 lakhs. Because it's for the sake of simplicity, we are not taking such charges. I've also given two more numbers, which is 160.2 and 200 with the same cost of acquisition. The idea behind giving this information is to find out at what times your sale value should appreciate for you for it to have a point of indifference. Or just to put it differently, what is the break-even levels? How much my income should have appreciated? My value of my property should have appreciated. So if you take 160.2, at that point in time, you will find, without running into the calculations, it's a mathematics one, you just don't want to run through that. You will find when it is 160.2, the tax under the old capital gains and new capital regime are almost the same. Which translates into the appreciation should have been 8.01 times, so just roughly take it as 8 times. If you are acquired in 2001-2, and if your property price is appreciated by 8 times or more, you will be better off under the new capital gains tax regime. If the appreciation is less than 8 times, you will be better off in the old tax regime. As I said you today, there's no option in law, but this is the point of indifference. You just want to make a thumb rule. This is the important aspect of it. You should take into account. That's why you find I've taken the next calculation is 200 on a cost of 20. If your consultation is 200, that means the value of the property is appreciated by 10 times. So 20 has become 200. So since it is more than 8.01 times, it's very easy for you to work out the number. So obviously the tax payable will be lesser under the new capital gains tax regime. It's 22.5, here is 25.48. You will find the new capital gains tax regime, you are better off in terms of the tax payable. That is because the appreciation of the property is more than 8 times. So this is a very interesting way of looking at it. But what are the real challenges? Now, because of the fact the computation of capital gains is going to remain as 100 minus 20 and 80. The capital gains computation is going to remain as 100, 20, 80. What will happen to your exemption? How much you should invest to claim the exemption? Because many people are in the impression that I can either compute the capital gains as 80 or as 27.4. Well, the answer is no. Your capital gains computation is only going to be 100, 100 minus 20, 80. So that means if I want to claim exemption, I cannot put 27.4 in another house, assuming that I'm eligible for 54 years. I can't put 27.4. I have to put 80 for it to make your capital gains 0. Now, assuming if I'm going to tell my mother, go and buy another property for 80 to save your tax, she said, why should I buy a property at this age? Give me a very simple savings instrument. Obviously, we would have all suggested go in 54 easy bonds. Now, if I gone for a 54 easy bonds, the same case, if I invested 27.4, my capital gains would have become 0. Now I can't put 27.4. I had to compute the capital gains only without indexation. So 100 minus 20, 80. That means I have to invest 80. But all of us know we are not allowed to invest. We are not allowed to invest more than 50 lakhs in the year of transfer and in the subsequent financial year. So for even if I want to claim exemption here in full, I cannot do it because my capital gains without indexation is 80. Since I'm allowed to invest only up to 50, on the balance 30, I have to pay tax. So therefore, it is not that the amendment which was passed by the parliament restored the old provision. No, it only gave a limited benefit to the extent of the calculation of tax payment. So in the subsequent slides, I'll just try to give you this a little bit more flavor of this particular point. So 2001-2, I just gave an example. So we'll just try to find out what if it is 2012-13. I will not run through the number, but I'm just giving you an indifference point here. You can find the indifference point occurs when it is 63.5, 20. When you index the cost of acquisition, you can find the tax payable here at 5.44 and 5.44. You will find this up. So that's happening when your property prices have increased by 3.175. So I was just trying to.
Suresh, sir,
Yeah.
only one point if I can intervene here.
Sure.
The previous slide. So now you have taken in the third column fair consideration, fair value of the consideration,
Hmm.
they have considered as 200.
Yeah.
Assume if you consider as 60 or 70, like there will be a capital gains loss in the old say CG.
I've included.
That you have a?
I have the subsequent slide. I'm having that.
Okay, sir. Thanks.
So here you can find the indifference point occurs at 3. If a property is acquired in 1213, the appreciation of the property should be 3.175 times for you to have this benefit. However, now of course you will be wondering, sir, should I have to make the calculation every year to find out? So what I did was just I had to use your our GPT. So that will give you this in flash. So, so with the help of AI, this number I have added it in flat 30 seconds. So I'm just trying to make query. This is what I want, and I just through the table. So as you can find, this number tallied with the calculation which I've shown. Because you almost always have don't totally trust the AI or ChatGPT in full. In fact, when I was just trying to put, it gave a number for 2001 to 7.66 times. I was so confident about my number. I said, why it's throwing a wrong number? And then when I just tried to analyze, it took the inflation index number as 348 as an estimated index number of the last year. Then I gave a prompt to it. No, don't use 348, use 3.363 being the actual inflation number. It took only a flash, just you have to put an enter button for it to throw this table. So you can find this is how year-wise reckoner or appreciation need. If your client wants how much appreciation, this is a simple number. So if it is 2002-3, the appreciation of the property should have been 7.55 times for it to be indifferent between the new capital gains tax regime and lower tax regime. So year-wise, I given this number. So now we will just dwell upon this point a little bit more. Now, so first we'll go back to the number. I've just tried to carve out only from that number. 2 examples I've taken. So one is 120/80, which I've already explained. So after indexation 27.4, which we already talked about. Now to claim full exemption, I need to invest 80 lakhs as against 27.4 lakhs as an erstwhile example. And the problem is, if I want to choose 54 easy, I can't even go for the full amount. I have to still pay tax on 30 lakhs. Another interesting point is for 20, take that number as 40. That means my indexed cost of acquisition, obviously from 72.6 will go to 145.2. Now, what this amendment says, the tax payable will be compared between 7.5 lakhs as per the new capital gains tax regime. Compared with tax payable, the old tax rate, which is 0, you don't have to pay any tax. That's a fantastic point. But I have a long-term capital loss of 45.2 as per the old capital gains tax provisions. Can I carry forward this 45.2? The answer is no. That is why I said it was a pretty smart move, if it can be called so. They said that we have restored the old provision, you can still have a choice. There's no choice and all. The computation of capital gains is always going to be 1 year of the new capital gains tax regime. That means the indirect implications of the same are going to be 1. You will not be in a position to claim the set-off and carry forward of losses. Need to shell out more amount if you want to claim exemption. So these are something which we do not know has intentionally happened or unintentionally happened. But this is a fallout of this particular provision. So therefore, my humble view always has been, when such a major change is proposed, we should never try to bring a proposition like this. In any case, in 6 months, we are going to completely rewrite the law. This should have been subject to wide debate. Allow the professional institutes like Chartered Accountants Institute, just give it to them. This is what we intend to do, take our opinion. And then if the proper legislator, I think our institute would have also given our views. That means, the entire provisions will have a much smoother sailing. This is my personal view. So let's look from the point of view of a non-resident here. Again, if he has acquired the property in 2001-2, same thing, nothing has changed. And if you're a non-resident, because you know that many people have left India and they have a property here. And at least my experience in recent times, most of them have got no intention to come back. But most of the time they ask me, try to get me a low deduction certificate, what should I plan to sell the property? My kids are not planning to come to India, blah, blah, blah. So now, because this provision has been introduced only in 112(1)(a), look the same scenario what happens in the case of a non-resident. The second part of the calculation is not going to be there at all for them because the property is sold after 23rd July 2024. 100 minus 20, 80, tax 10, 100 minus 40, 60, 7.5. That's it. The question of making any calculation for them for non-resident does not arise at all. So this itself is available only for individual HUF resident in India. So therefore, the entire slide I've taken it again. So that part of it will not have any effect on non-resident individuals. So of course, companies, partnership firm and all, not the question for them automatically the benefit is not going to be available. Even for NRIs, this benefit is not available because that tax payable calculation to 112 comes under a different clause and therefore they also don't get the benefit. So a couple of interesting points which I want to really think about. Now, what will happen if the assessee inherits the property from his parent on or after 23rd July 2024? Will the resident individual get the option? In fact, you can also see when Economic Times had a flash in the first page, it said the finance minister has told that this amendments will not affect inherited properties at all. Now, if the assessee inherits the property from his parent on or after 23rd July 2024, how do you make the calculation? Now, let's just go back first. What is the law? If the property is acquired by way of inheritance, Section 47 specifically provides that transaction is not going to be considered as a transfer. Then what happens to the cost of acquisition? Just for the sake of simplicity, assuming that I get a property inherited from my father. Because I got the property by way of inheritance, there is no capital gains to my father, the transfer. Now, if I want to subsequently sell the property, can I take a stand? There is no cost of asset to the asset, therefore there is no capital gains. Applying the principle laid down by the Supreme Court in B.C. Srinivasa Setty. Obviously, the answer cannot be like that. So therefore, Section 49, subsection 1 specifically provides you have to take the cost as the cost of the previous owner. So that means in this particular case, though I've inherited the property my father, so let's assume I got it inherited on 24 July 2024 and I plan to sell today on 29th of August. Now, what is the cost to me? The cost of acquisition of the capital asset to me will be cost to my father. Fine. So what will be the nature of capital gains? Is it going to be short term or long term? Now, 242A explanation specifically provides if the cost is determined under Section 49(1), then for computing the short-term or long-term capital gains, you must also consider the holding period of the previous owner also. So I have to take the holding period of the previous owner. What if my father has acquired this property before 1/4/2001? 55 subsection 2 clause B subclause 2 specifically provides if you acquired the property in the mode specified in 49(1), and if the previous owner has acquired the asset before 1/4/2001, you can substitute FMU on 1/4/2001. What happens if my father has done some improvement? Again, 55(1) specifically provides the cost of improvement made by the previous owner can also be considered. So therefore, I can take my father's holding period, I can take the FMU on 1/4/2001 or stamp valuation on 1/4/2001. I can take my father's improvement, but what is going to be my tax treatment here? Because if you just, I will take you back to that change again. So, see, please understand, this was given under the pretext of this is a trailer to the simplification of law. Now you read the section. This is a change. Provided further that in case of a transfer of a long-term capital asset being land or building or both, which is acquired before 23rd July 2024. When did I got the asset? 24th July 2024. Who is selling the asset now? Me. What is the nature of capital gains? Long term. What is the cost of acquisition? cost of my father? Can I take the improvement father? Yes. Can I take the holding period of my father? Yes. But can I choose in this particular case 20% with indexation or 12.5% indexation? Can I choose? Logically, the answer should be yes, because if you look at the sequence, the harmonious construction of the law, the acquisition of the previous owner is considered, holding period of the previous owner is considered, improvement of the previous owner is considered, but 112.18 talks about in the case of a transfer of a capital being land or building or both, which is acquired before 23rd July 2024, whether in 49(1) cases, whether this should be taken as acquisition by the previous owner also, or we have already faced enough litigation at the time of indexation. Most of you would have faced this litigation in the real life, because department was unfortunately not allowing indexation based on indexation of previous owner. Let's assume my father has acquired 1/4/2001. I got the asset in 24/25. If you go by 48 second proviso, it was talking about the definition given in expression 3 to section 48. Indexed cost of acquisition means cost of acquisition into the index of the year of transfer divided by the index of the year of acquisition or index of base year, which is 2001 to whichever is later. So what therefore as department was trying to do? When did you acquire the asset? 2024-25. When is the year of transfer? 2024-25. Therefore, numerator, denominator, both were taken as 363. That means a capital asset cost of 1 lakh in 2001 to after 22 years of inflation will remain as the same. And that is how department argued. Purely on the technical grounds of the section, there's a law saying they were not trying to give a harmonious construction, which was given by many courts in India. I said, once the acquisition is under 49(1), the holding period of the premium is considered, indexation should be also based on the acquisition of the previous order. Applying this logic, they are not specifically said, we read this particular point, it's very interesting, which is acquired before 23rd July 2024. The section does not mention which is acquired by the assessee before 23rd July 2024 is not there. Therefore, in 49(1) cases, there is a very strong possibility for us to contend if the asset is acquired in the mode specified in 49(1), acquired by the assessee or the previous owner, as the case may be, has to be done. It's very important as a government intends to simplify the law and make it very simple. And in economic times, it was specifically mentioned inherited properties will not be impacted by this change. I presume the board will come out with some clarification, specifically provide in 49(1) cases, this will be taken on the basis of acquisition by the assessee of the previous owner, as the case may be. Don't interpret that way. The problem for me is that my father got the asset before 23rd July 2024. I determine the cost as per 49(1), but since I got the asset on or after 23rd July 2024, so they may say you are not eligible. When did you acquire the asset? After 23rd July 2024. They may say that provision does not apply. This is apply only for assets which are acquired before 23rd July 2024. So therefore, logically, in 49(1) cases, this has to be taken by the assessee or the previous owner, as the case may be. Now, just you bear in mind, the intention of this is to make the law simple. So always that's why you find, in the last 15-20 minutes, you would have seen, it is not as simple as what possibly most of us would have imagined. It is very intentional is good, but however, when you go to the fine print, you will find. The next point, option is available for land or building acquired up to 23rd July 2024. What is the meaning of acquired? So in the state of Tamil Nadu and all, at least in South India, I don't know about North India, so therefore, sorry for that. But here, there are certain months are not considered as auspicious for registration. People don't go there. They say the period of that 1 month, they generally should be devoted to the god, or they say that they don't want to do. So different gods of worship. But so again, coming in from the next month, so take another September 15 to October 15 is a different month. People don't do much of things because it's for that. So the previous month also was like that. So till August 15, people generally don't want to register property for some reason. It's a sentimental, we are all emotional, right? So therefore, I don't want to do a registration. But however, I have taken the possession of the property. Actual registration takes place after 23rd July 2024. Now, when did the acquisition of the property take place? Can I say that I have acquired the property before 23rd July 2025? Because please understand, this benefit is available only for properties which are acquired before 23rd July 2024. If the registration happens after 23rd July 2024, but the possession is taken over, what will be the position? It's a very interesting part. Of course, you would have read many decisions that the courts have held that if the possession is taken over and the registration subsequently happens, the date of takeover of possession should be considered. Can also make a reference to 247. So many things are there, but of course, it's better the board comes out with a clarification so that we don't get into the litigation which was intended to be reduced by this amendment. Take another interesting case where the capital asset is converted into stock in trade for 23rd July. A stock in trade is sold after 23rd July 2024. Now, this new capital gains tax regime, when it is applicable, the new capital gains tax regime is applicable if the capital asset is transferred on or after 23rd July 2024. If the transfer happens before 23rd July 2024, again, you will be only under the new tax, under the old one. Only if the capital asset is transferred on or after 23rd July 2024, you have to go by this new page. Now, 45 subsection 2 deals with conversion of capital stock in trade and the tax implications. 247 clause 4 deals with the definition of transfer. There 247 clause 4 says any conversion of capital asset into stock in trade will be regarded as transfer when on the date of conversion. Let's assume on 10th July 2024, I've converted my capital asset into stock in trade. So I have some land in different areas. I converted this land into stock in trade. I start a business of real estate. I've taken this land into stock in trade. Now, what 45 subsection 2 says, when the capital asset is converted to stock in trade, both capital gains and business income will arise only in the year in which stock in trade is sold or otherwise transferred. Assume I sell this land on 1/4/2025. So when does the capital gains going to arise? The capital gains will arise only in the previous at 25-26, assessment date 26-27. That's the year in which the capital gains going to arise. Business income will also arise in the same year. But when did the transfer took place? As per section 247 clause 4, the transfer takes place on the date of conversion of capital asset. That means the capital asset has been converted before 23rd July 2024. Therefore, the transfer is already over. So what does the law says? You will not get the benefit of indexation for assets which are transferred on after 23rd July 2024. It doesn't talk about in which year the capital gains is computed. Transfer is complete before 23rd July 2024, but taxability arises in the subsequent year. Will I get the benefit of indexation? All the old capital gains regimes. On the plain reading of the section, the answer appears to be yes. How the utility allow it? Utility did not even allow from July 5 to July 30th. Even 87A rebate is available for 111A and 112. So therefore, when a proposal is made to simplify, maybe a larger debate possibly might be required. The intent is good. Definitely, we have to appreciate that. Now, what has happened in the case of a compulsory acquisition of land? You all know that many ports are coming, many new projects are coming. So today we are able to travel across India beautifully with an extraordinary roads, which requires huge acquisition of land or building. So again, if the land is acquired before 23rd July 2024, 247 clause 3 specifically says any compulsory acquisition of your capital asset is a transfer. When does the transfer complete? The day on which the collector passes the order acquiring your land, on that day transfer is over. But 45(5) says the capital gains will arise only in the year in which the compensation or part thereof was first received by the assessee. So capital gains is getting postponed to the year of receipt of the compensation, but transfer is already complete on the day on which your collector puts an order taking over your land. So now the question is that my land has already been acquired before 23rd July 2024. But I get the compensation government post that. Will I come under the old capital gains regime or new capital gains regime? Actual capital gains arises only the next year. Let's assume government delays my compensation based only the next year. In Chennai, they are going to construct a new airport. Already a lot of lands have been identified. The farmers there in that area are under protest. I have a land there, let's assume. My land I have already given to the government. But the government has not given me any money. Assume they give it on 1/4/2025. Already my land has been acquired. Transfer is already over. But I don't have to pay capital gains tax because of 45(5). I have to pay capital gains tax only when I get the compensation. Now, assessment at 26-27, should I have to go and be old or new? That's the question. In my view, on the reading of the section, since the transfer is before 23rd July 2024, I will go under the old capital gains tax regime only. So these are some of them. Of course, we can just keep on and on. I just want to throw only small insights onto how this change is not as simple as many of us think. Yes, the idea is good, very easy to calculate, but when just go and just try to apply in some real life scenarios, you find definitely we are heading some very, very exciting times. As a professional, as somebody who talks on capital gains or breathes on capital gains, I am extremely happy with this proposal. I'm very honest with you. What else you want as a speaker? This is what you want. The law is going to be so simple. I think we are not needed at all. But I'm very happy this was given in the name of simplification. That's what makes it more interesting. So therefore, I just having a field day from 23rd July 2024, from 29th July, the last day, so many programs. Every day, every time when you see this, new point comes. Some of these points today are when I'm preparing for today's session. So therefore, from 23rd July 2024, every day is learning. I'm very, very thankful to the finance minister and the entire team which is behind this amendment, because I'm extremely happy and delighted, because that really makes my job a little bit more interesting. So just moving on, of course, on the short-term capital asset, because I don't want a situation where I just discuss only one issue. Let's just at least have 2-3 issues. Short term, of course, in my first edition of capital gains book itself, I specifically said all capital assets should be made as 24 months, including listed shares. I don't agree with the fact that listed shares are going to should remain as 12 months. Nobody is going to be. I'm an investor in shares. I don't invest for 1 year to become long term. I am generally an investor always for 5-6 years. That's what we talk about. We always talk about that kind of SIP. So many things we talk about. So it's long term is definitely not 12 months. I don't think the listed shares deserve the 12 months. It should also move to 24 months, or you could have moved all as 36 months. Not a problem at all. Instead of increasing the tax rates relating long-term or short-term capital gains, holding period increase would have been much better logic according to me. So that will be one way we could have simplified. Of course, definitely a good effort was made in this case, barring the listed securities units, they keep the 12 months. The rest of them, all of them brought to 24 months. Of course, there are a few interesting niggling issues there, which I will talk about if I get the time. So apart from it, this 112A, 112 and 112 have been changed. And in my view, it's a very surprising change. I just wanted to take it back to the history once again for you to understand as to why this particular change may not be the best of the changes. Now, so what has it changed first? From 15% we have moved to 20%. It's not a 5% increase, which reflects an increase of 33.33%. So 112A, 10%, which is moved to 12.5, which is an increase of 25%. So long-term capital gains, 12%, 20% after indexations, 12.5 without indexation, which of course, there's a reduction of 37.5%. Very good reduction. And threshold limit of 120 from 1 lakh to 125, just 25%. Now let's put a little bit of an history. Read it as 1st March 2023. So initially for listed shares under 1036, the entire capital gains is completely exempt from tax, and there is no security transaction tax also. If you sell a listed shares, I'm just for the sake of simplicity, keeping it as only shares, entire capital gains is fully exempt from tax. No STT also. But 1038, which was introduced on 1st October 2004, from 1st October 2004 to 31st March 2008, again listed shares got the exemption from tax. But that is subject to a separate tax being levied under Chapter 7 of the Finance Act by name of STT, which initially was required to pay at the time of transfer and subsequently was extended to pay at the time of transfer as well as acquisition. If you pay STT, then the entire capital gains was fully exempt from tax. So therefore, we must understand the rate of tax under 111A and the exemption under 1030 for long-term capital gains was given only because of the fact we have been collecting some tax upfront as a transaction tax, which up to the first 4 months was close to 17,500 rupees, 17,500 crores was a collection of STT in the first 4 months of this financial year. You can look at the amount of STT collected, 17,500 crores in the first 4 months. So therefore, to give an impression that this is an exemption given or a lower rate of given, that is conceptually incorrect. That lower rate or exemption is given primarily because of the fact I'm upfront collecting a transaction tax. Now 112A, which was introduced on 1st April 2018, the rate of tax was fixed at 10% of the long-term capital gains in excess of 1 lakh. And I have absolutely the long-term capital gains tax can be 10, 20, 30, 40, no problems at all. But we must bear in mind, even this 10% of tax is because you are already collecting your transaction tax, and over and above the transaction tax, this 10% tax is collected. That's what we must understand. If STT is removed, keep your long-term capital gains tax even at 35%, not a problem at all. You are collecting a transaction tax upfront, and that is the reason behind the exemption given earlier, and that is the reason behind why there was a 10% tax collected. Only 10% tax is collected. Now, without removing the security transaction tax, the rate of tax on long-term capital gains after an increase of a small 25,000 increase in the threshold limit has been moved from 10% to 12.5%. So the problem is not with the reference to the rate. The problem is with the reference to the concept. Let 112A be even 50%, 40%, not a problem at all. Tax the person who was making profit on sale of transaction at 40%. That's a different topic altogether. Now, the basic premises of exempting long-term capital gains or the basic premises of charging only 10% in excess of 1 lakh was I am already collecting some other tax upfront while do the transaction, irrespective of whether you make a profit or loss in the transaction. Please understand, STT is payable whether you make profit or loss from the transaction. So I already collect upfront, irrespective of whether you earn income or not from the transaction. After that, you are also collecting a 10% tax. That 10% tax increase 12.5%. This conceptually appears to be incorrect. Whatever be the reason, you already collected. Put 40% tax under 112A, no problem, but remove STT. Having STT and also this, there is a dual taxation. So as a conceptually, that is my issue with this current discussion. So same thing what you must also understand in short-term capital gains on listed shares. it initially started with 10%. Why 10%? If you go to that assessment year, 2005, 2006, that's the first slab rate. STT was subject to 10% tax. What's the logic here? Because though I collect transaction tax, I don't want you to sell or exit. These are all capital market incentives. That means I want you to hold it for a longer period of time. Therefore, restricting this benefit only to long-term capital gains, fair, logical, justifiable. So therefore, I want to discourage you in selling the shares at a short-term period. That's why even I said the short-term period, you can even keep it as 36 months also. That's not a problem, because when you invest in shares, you should think about a long-term only. So therefore, a 10% tax was fixed, which is the first slab at that point of time. Again, from 1st April 2008 to 22nd July 2024, the tax was at the rate of 15%. That means on 1/4/2008, the rate of tax was changed from 10 to 15%, but with very interesting logic was given. So what is the logic given at that point of time? Typically, from our shares, you get two incomes. You get a dividend income, you get a capital gains. Dividends at that point of time was subject to tax in the hands of the company at the rate of 15%. Typically, you would have read in your financial management, the return per share consists of two components, dividends and capital gains. Typically, if a company makes a profit and if it has got highly profit-making projects, it will come and explain to you, I want to invest in those projects, which will increase the earnings, which will increase your share price. Therefore, what I'm not distributed to you, in any case, you're going to get back by way of an appreciation of the share price. That means I want to return you by way of a capital gains as one option. Alternatively, I distribute the profits, take it by way of a dividend. So therefore, typically when you invest in shares, you get either a dividend or a capital gains. Since the dividend is getting taxed at the rate of 15%, the government at that point of time said, we want your capital gains should also be taxed at the rate of 15%. Though I mentioned at that point of time, if you want to bring it neutrality, okay, fine, retain short-term capital gains at 10%, reduce the dividend tax to 10%. If you just recall, when the dividend distribution tax was introduced for the first time, the rate was only 5%. Then it moved to 10, then it moved to 15. And that is how they kept on increasing the rates. But from 23rd July 2024, that 15 was made as 20. Please understand, it's not about whether you charge 15, 20, 25, 30. Please tax the short-term capital gains on listed shares at normal rates also. Let the people pay at 35% also, not a problem. But we must understand this 10 or 15, the concession rate is only because upfront transaction taxes levied. But what they are trying to say in the memorandum, the present rate is too low, and the benefit from such low rate is flowing largely to high net worth individuals. No, absolutely, is the tax rate is not a problem, but the point which was missed out, the lower rate of tax was there in 111A because we are already collecting upfront a transaction tax, and that is the reason why it was 10 or 15. So if you remove the transaction tax and then put 40%, why short-term capital gains should be taxed at a concession rate? No problems at all. But the logic here is that, is it justified to levy both the transaction tax as well as push the tax rate on this also? That is the only question. And that is a very important question to be really pondered about. So it's not the rate of tax. I think we are discussing on the rate, whether it should be 10 or 15 or 20. Not about that. There is a transaction tax plus an additional tax. That is the only point. So moving on to 47 clause 3, which is another very interesting amendment. So the existing provision was talking about any transfer of a capital asset under a gift or will or an irrevocable trust, which we also discussed at the time of indexation also. So any transfer of a capital asset by individual or HUL under a gift or will or an irrevocable trust. So therefore, there's a small insertion was made. Any transfer of a capital asset by an individual or Hindu undivided family. So that means going forward, or rather from assessment year 2025-26, The benefit of 47 clause 3 will apply only for individual or HUL. Now, the logic which was given for this, the gift is given out of natural love and affection. And accordingly, it is proposed to substitute clause 3 of section 47 and its proviso, provide that nothing contained in section 45 shall apply to a transfer of capital asset under a gift or will or irrevocable trust by individual or a Hindu contributed family. So basically, the question here is that there was a case where a trust was giving a donation, and there is a question of a company giving a gift to another company. So what the government feels here is that gift has to come out of a natural love and affection. How a company, when it makes a gift to another company, what is the love and affection here? So therefore, it defeats the fundamental concept of gift, which is something given to another person out of love and affection. When you just try to create a corporate gifts or gifts between entities which are not natural persons who cannot have a love or affection, that should not get the benefit. No, but the only point here is that, is this already captured in tax? That's the point what we have to understand. Now, without this amendment, what was the position? Is a question. At least it's understandable till 31st March 2017. The erstwhile provisions of 5625, 5626, 5627, all of us will be aware of 5625, 6 and 7, where the gift is captured in the hands of the recipient under income from other sources. Both 5625 and 5626 are applicable only for cash gifts, whereas the scope of 5627 from 1st October 2009 has been extended to movable and immovable properties also. But 5, 6, 7, all of them had one problem. They all are applicable only for individual or HUF on the same premises that any gift can be given only to an individual HUF, because the gift prima facie supposes that there is an element of love and affection. But when 5610 was introduced from 1/4/2017, the section says any person to any person. So already from 1/4/2017, if a company makes a gift to another person, though the transferor is not subject to capital gains under section 47 because of the exception provided by clause 3 of section 47, what happens to the transferee? What happens to the recipient? The recipient is subject to tax under 56(2)(10) of the Income Tax Act, because the provisions of 56(2)(10) are applicable for any person. So that means the corporate gifts are now already going to be captured under income from other sources. But the government feeling here is that, so since it is only going to be natural love and affection, corporate gifts should be brought to tax in the hands of the transferor also. Though the transferee is also getting taxed here, already getting taxed. Even transfer also they want to bring tax, because they are under the impression that the courts have failed to appreciate the existence of the provisions of 50D, which specifically provides if the consideration is not ascertainable, the fair market value can be taken as a consideration. But 50D only provides for computation of capital gains in the event of consideration but not determined. But what is very important is, in order to come under capital gains, the first condition required, there must be a profit or gain. 2, there must be a transfer, and the transfer must be in relation to a capital asset. Now, section 47, you can see the pre-amendment, it talks about any transfer of a capital asset under gift or will or irrevocable trust. So there the section was not restricting the scope of this particular section to any particular asset. Since they said that gift can be only out of love and affection, this 47(3) in any case does not apply. If the consideration cannot be determined, you can always have 50D. Since that has failed the test of court approving the same, they thought we should make a change to the law. Now, the indirect fallout of this would be Let's take a small example for this. 10,000 shares have been transferred X Limited to Y Limited. The fair market value of which is 100 lakhs. Now, prior to this amendment, already Y Limited will be subject tax on the income from other sources to extent of 100 lakhs. Already Y Limited is going to be taxed. This amendment now paves the way of taxing X Limited also to the extent of 100 lakhs being taken as a full value of consideration, subject to, of course, the cost of acquisition will reduce. Therefore, this amendment now comes at a very interesting point. It, apart from subjecting to the recipient to tax, it also brings the transfer of also to tax under capital gains. Therefore, the impact of this amendment is once again going to bring, just like what's happening in the 50C, where both buyer and seller are getting charged for the same transaction. The same is going to be the implication is here. After this amendment, both transfer and the transferee are now going to be subject tax both under capital gains and of course under income from other sources for the recipient. So that is a very small change. Since this change has not been much talked about, I thought I can just make a brief touch on that. So now, what is another very interesting change? So buyback of shares. Now, the buyback of shares earlier was covered under 46A, but it was only considered as a capital gains. Then 115 QA was introduced from assessment at 13-14 for unlisted shares, where the company will have to pay tax, which is called as an additional tax. And for the recipient, in the event of the additional tax being paid, gets exemption under 1034A of the Income Tax Act. Possibly most of you may be aware of, it is because of the fact there are certain countries with like Mauritius or Singapore before the DTA amendment, there is no tax on the capital gains. So it is going to come under capital gains if you're a resident of Singapore or Mauritius and similar countries. So if the transaction is going to be called as a capital gains tax, so again, since in the resident country there is no capital gains tax for them, buyback of shares becomes tax efficient. They are not going to pay tax anywhere. So that's why basically it was introduced for unlisted shares to plug this loophole. And of course, subsequently, this was extended to listed shares also. So therefore, now whether you are listed shares or unlisted shares, till 30th September 2024, there is going to be a 20% tax in the hands of the company and the 115 QA called as additional tax. Please understand, this tax is over and above the 26-27% tax they would have already paid. Because obviously buyback, I'm going to do out of my accumulated profits. Instead of distributing as a dividends, I'm just trying to buy back the shares. So in any case, I would have paid around 26-27% tax, another 20%. Already the government has collected 47% tax already. But what they are trying to do now, if you are a shareholder and if you are under the highest tax bracket, you will get this amount which you receive on buyback as exempt from tax. Assuming for a moment that you are a promoted entity participating in the buyback, and you will be already under the highest tax bracket, assuming that you are in the new tax regime, the 25% surcharge in the last tax bracket will be close to that slab rate. So if you are getting the amount from buyback and you are getting exempt from tax, this benefits the people who are in the higher tax bracket. And therefore, I don't want this being used as a tax avoidance measure, or as buyback as a structure of tax avoidance should be avoided is what the thought process. So the what they say that 1st October 2024 onwards, so they have not gone back to 46A. They don't say that I want to bring it under capital gains tax, because we know that in the capital gains tax rate, if it is a long-term capital gains, we all know in the case of listed shares, still without indexation, only 12.5% tax. So therefore, they made a very interesting point. This buyback will be considered as a deemed dividends under section 222F of the Income Tax Act. So they don't want to go back to the old provisions. They know that again is going to benefit the shareholders. In fact, we may be in a slightly worse off situation. So therefore, here The idea was the promoter entities, if they're just trying to exit and then try to save tax instead of by paying 20% tax in the hands of the company, just want to push them to a higher rate of tax. Just like the same concept in the case of dividends. The company pays a dividend distribution tax is going to pay at 20, the shareholders are going to pay tax at say 39%. Why don't they take it? So that's the basic point. So therefore, this also they are trying to call it as a deemed dividends. But the way in which it's going to work is very important, because not all, suppose you have 1,000 shares and even if you tender all the 1,000 shares more than what you are entitled to tender, because normal the acceptance ratio is going to vary. Let's assume the acceptance ratio is only 10%. If you have 1,000 shares, and the acceptance ratio is 10%, only 100 shares will be bought back, though you have 1,000 shares. The 900 shares are going to still remain with you. Now, the only point what is going to happen is that the amount you receive from the company is going to be considered as a deemed dividends. And what will happen to the shares which are extinguished after buyback? Just for the sake of simplicity, we'll assume you have 1,000 shares purchased at the cost of 200 rupees per share. The 2 lakhs is the cost. The company buybacks 200 shares at 250 rupees per share. So that means though you have 1,000 shares, though you have tendered the entire 1,000 shares for buyback, the company accepts only 200 shares. That means you are going to be left out with 800 shares still in your hand. But 200 shares have been brought back at the rate of 250 per share. That means the entire 50,000 is going to be considered as income from other sources, because 222F makes it very clear. Whatever you receive from the company will in entirety, without any deduction, is going to be considered as income from other sources. No deduction will be allowed. Full 50,000 will be considered. But how much shares you will be left out with? Only 800 shares. But for 200 shares also, you would have paid. Take our example. I bought 1,000 shares at 200. 200 shares I bought back, and the entire 200 into 250 is taxed. So what happens to my 200 shares in 200? 40,000 rupees of cost. If they said 50,000 minus 40,000, only 10,000 will be taken as income from other sources, there is no problem. They said the full 50,000 I will take it as income from other sources. Therefore, the logical question which arises now, what will happen to that 40,000 cost which have incurred? So they have amended 46A. So in 46A, they specifically say that in respect of the 200 shares which has been bought back, the consideration will be considered as zero. The consideration will be taken as zero. So assuming the shares are held for less than 12 months or 24 months, as the case may be, their entire cost will be considered as a short-term or a long-term capital loss. I have assumed to be short-term, and therefore put it in the slide as a short-term. And that loss, of course, will be treated like a short-term capital loss or long-term capital loss, will be accordingly available for set off and carry forward. So effectively, what they have done is the entire amount is capitalized as income from other sources without any deduction. And if your tax rate is above 20%, obviously the government will stand to gain. And if your slab rate is less than 20%, obviously the government will lose, but they feel that it's fine. If a person with a lower tax slab rate gets a benefit, I'm fine with that. I only want to tax the person who has got the affordability, who has got the money, and therefore let him pay tax. If the people under the lower tax bracket, if they get some tax saving, I'm fine. I'm extending the benefit to the people under the low income group. So they are fine with that. Now, what if in this particular case, I will purchase the 1,000 shares at the rate of 200 rupees per share, 2 lakhs, by borrowing, and I have an interest. So what will happen to the interest on capital? So that's a very so can this interest on capital borrowed for investment in shares be added to the cost of acquisition? Maybe to the extent of 200 shares which is sold. So can I add it to the cost? Because the consideration for the 200 shares has been taken as zero, less cost of acquisition, there is going to be a capital loss. consistently the courts have held the interest on capital borrowed for investment in shares will be allowed as deduction, provided the same has not been claimed as a deduction in some other head of income. Even in section 48 also you will be aware of, there's a specific amendment also, that the interest on capital borrowed will be added to the cost so long as it has not been claimed as a deduction in some other head of income. For example, if you claim deduction for interest on housing loan, and you cannot again claim, but if the expenditure is not claimed, so can I add it to the cost? The answer appears to be yes. Now, whether the loss to be allowed to be set off against deemed dividends under section 224F. So the problem here is a short-term or long-term capital loss can be set off only with capital gains. Short-term can be with both short-term and long-term. Long-term only with long-term. Now, since the loss is only going to be a short-term capital loss, and since the amount I receive and buyback is taxed as income from other sources, it will become very difficult for you to claim this loss against income from other sources. Now, even though the income from this, though taxed as the income from other sources, the nature of income, possibly you would have heard. The Supreme Court in Brook Bond India in many cases have observed, if the nature of loss is business, even if the head of income is different, for the purpose of set off and carry forward, it should be considered only as a business loss. Whether such an aggressive stand can be taken may be very difficult. And even if you take, how do you fill up in the utility? It's all the more going to be difficult. But however, possibly the government could have considered this particular point. They could have said, okay, the loss you can adjust against the deemed dividends could have been a better provision. But let's hope in the next budget something happens like this, or when the law simplified, get right. Even my suggestion for quite some time is that we should have a separate head of income called income from securities, not interest on securities, which we had earlier. I would call it income from securities, where all securities, shares, futures and options, all of them, we can bring it to a separate head of income. All the dividends, capital gains, all this F&O losses. Let's try to bring it under one head of income. Therefore, there's no confusion whether shares is held as a stock in trade, whether shares is an investment, how to determine whether it's investment or stock in trade. I hold it for 40 days. Can you call it investment or stock in trade? I hold for 1,300 days. So instead of trying to confuse by what is the nature of income, we can have the sixth head of income, income from securities, where all securities, F&O, dividend, anything related to securities, all brought under one separate head of income. And that possibly could solve many of this issue while drafting the new income tax law, which attempts to make the law simple. Maybe if they consider that would be fantastic. Kotaji, do you have a time or can we discuss?
So we actually have a lot of questions as well.
Another
So
10,
attention
15 minutes, sir, or if you can take the questions.
How
How much time it will take?
This one will take, I'll just try to throw the issue and then leave it. So what could be the potential implications of that? If we take it in length, it will take 45 minutes to 1 hour. But what I will do is I will just briefly discuss what is the issue involved and throw some light on the controversy. And then, of course, we'll take up the questions. Anyhow, I leave the presentation for them to, if they have questions, possibly they can put the questions of DTC also. Maybe we'll try to answer through the tax committee. But anyhow, I'll just set the tone because it's a very interesting issue here. So therefore, maybe 5-10 minutes I'll spend. Post that we will take the questions.
10 minutes, 5 up to 5:45 you can do.
Yeah.
So only one clarification. I hope I can ask one question.
Sure, please.
In case of capital gains, you have written that loss. No, don't go to the this thing. No, not required.
Okay.
Land and building, where there is a capital gains loss, it cannot be carried forward. My submission is even it cannot be set off during the year also. Am I?
Yeah, both set up and count, both are gone.
Okay.
In fact, you don't get the loss at all. Where is the question of
Correct,
set up and carry?
Correct. Cannot be carried forward.
The
and
loss
also set
itself
off
is not
in the carried
computed at all.
Correct. Another 15 minutes you can take, sir.
Yeah. But so basically, the one very interesting issue here is that now Section 50C provides for substitution of stamp valuation as a deemed consideration in certain circumstances. All of us are familiar with that. As I was mentioning earlier, like in the time of discussion of 47 amendment, which results in double taxation, this double taxation was already there under 50C with 56(2)(7) as well as 56(2)(10). But the difference between the stamp valuation and actual consideration is considered as income from other sources. The same transaction, both in hands of transferor and the transferee are getting taxed. Now, 54(EC) and 54(F), they provide for exemption for reinvestment in another residential house and or specified bonds. Now, the only question here is that in 54 and 54(EC), as we discussed also, it is sufficient to invest the capital gains. The only problem now is that because there is no indexation, we may have to invest a larger investment. Whereas in the case of 54(F), there is a requirement to invest the net consideration. So we need to invest the net consideration, which is full value of consideration minus expenses. Now, the interesting issue is that for 54 and 54, you see, what is the capital gains? Is it the capital gains based on the actual consideration, or should I have to use 50C deemed consideration also for the purpose of capital gains? Similarly, in the case of 54(F), when I say I have to invest the net consideration, is it the actual consideration minus expenses in connection with the transfer, or is it the deemed consideration, which is the stamp valuation? Should I have to take the stamp valuation minus expenses, whether I have to invest that amount? So, or to put it in a slightly different language, should I have to use actual capital gains and actual consideration for the purpose of exemption purposes, though computation purposes under Section 48, I try to use 50C amount, or the 50C should automatically be put into both computation and also for exemption? So there are some conflicting decisions are there, but anyway, we'll just try to run through what each code is trying to say. Let's try to get into what Bombay Code has got to say on this particular point. But for this purpose, which we'll try to have some numbers so that we can appreciate this particular point. The numbers need not have to be exact numbers, and the numbers given for more easy understanding. So the return which is filed by the assessee is 25 lakhs. The cost of indexed cost 4 lakhs, 21 lakhs, and he has put 25 lakhs in 54(EC) bonds, and therefore he claimed the entire 21 lakhs as exempt, and therefore filed the tax returns with long-term capital gains of 0. So 25 lakhs is what my consideration on the land. 4 lakhs is my cost or index cost, as the case may be. I have 21 lakhs of capital gains, and I invested the full 25. But because I can invest only up to capital gains for the purpose of claiming the exemption, I got 21 lakhs of exemption. But assessing officer took the stamp valuation as 53 lakhs 50,000, and therefore he recomputed the capital gains as 5350, 4 lakhs 4950. But since I've invested 25 lakhs, of course, he was courteous enough to give exemption up to 25 lakhs. So the long-term capital gains is computed as 2450. Now, from the point of view of the assessee, he has got only 25 lakhs. So, no way you could have invested more than 25 lakhs. Whatever amount I got in my hand, actually, I've invested. Therefore, his point of view is that though the capital gains as per Section 50C is 49 lakhs 50,000, for the purposes of 54(EC), for the purpose of 54(EC), the capital gains should be taken as 21 lakhs. And if you read 54(EC), what it will say, if you have invested the capital gains in the bonds mentioned in 54(EC), the entire capital gains will not come within the charging section. They don't use the word exemption at all, as we colloquially try to use. The 54(EC) or 54 says the entire capital gain shall not be charged to tax under Section 45. So therefore, if I take the actual capital gains of 21 lakhs and invest in 54(EC) bonds, the assessee's contention was entire capital gains is not chargeable tax under Section 48, and once the charging section is not there, blah blah, rest of them automatically fall apart. This is the background. Of course, obviously, the department point of view, this virtually makes 50C redundant in the present case, because whether the stamp valuation 30 lakhs, 40 lakhs, 50 lakhs, 60 lakhs, the assessee will always make a claim. I have put the actual consideration minus index cost in REC bonds. Therefore, you do anything on the stamp valuation, I don't have to pay tax. So effectively, the department's strong contention here is that if you don't inbuild 50C for the calculation of 54EC, the entire 50C becomes redundant. So therefore, what we are left out for our discussion is that should 50C automatically find its way for calculation of 54EC, or only the actual consideration, actual capital gains. So let's just try to briefly just go to look at the section here, and just want to bring the extract so that all of you know, but just for the sake of easy reference. If the cost of the long-term specified assets not less than the capital gains arising from the transfer of a original asset, the whole of such capital gains shall not be charged under section 45. So therefore, it takes it outside the purview of the charging section. But what is most important? What is the capital gains? What is the meaning of capital gains here? Is this capital gains? Is this capital gains? Stamp, that is 50C consideration minus cost or index cost, or 50C is there only for computation, and this will not apply for 54EC. And to add it to this also, if you look at 50C also, this is the problem of 50C also. So 50C does not say notwithstanding anything contained anywhere in the act. It's not, it doesn't start with a non-obstante clause. So instead, if you see something which I've tried to show it in bold, the value so adopted or assessed shall for the purposes of section 48 be deemed to be the full value of consideration. So unfortunately or fortunately, instead of overriding the entire provisions of capital gains or the entire income tax act, 50C only says for the purpose of 48. 48, all of us know, it's a computation section. Only for the purpose of computation of capital gains, full value of consideration should be taken as a stamp value. So as the chairman wants to have some, sir, you think chairman has come. Chairman sir, you want to share? Let's know.
Thank you very much. If you finish questions, I will address
Yeah.
next 5 minutes. Kotak sir would be addressing now, Subhashini, or yes?
Kota sir has already addressed. Sir. He gave the
You finish question. So you may continue with questions. I'll address maybe in 5 10.
Okay, sir.
So therefore, the SSC's contention here is that effect of deeming provision should be limited to the purpose for which the same has been enacted. The relevant provisions would require the harmonious construction. And of course, most logically, if I had 25 lakhs in hand, you don't expect me to claim the exemption. Full 53 lakhs 50,000, which is the deemed consideration. I have 25 lakhs. How can you expect to do something which is impossible to do? Of course, their revenues point are pretty simple. This will virtually make 50C redundant. The exemption provision should be strictly considered. I think the exemption provision should be considered, liberally considered, but nevertheless, that's their point of view. The assessee can claim exemption only in relation to investment made in the specified bond, not beyond. I think this point I would like to clarify here. You just try to put this number, just try to fill up the calculation here. Now, if the assessee here says, having invested the full 25 lakhs, my capital gains has got to be 0. So if I have to achieve the capital gains of 0 after substituting 50C in the computation, by investing 25 lakhs, you just make a filing in the return of income. When you put it in the return of income, you will take full value of consideration as 5350. Cost or index cost is 4 lakhs. Long-term capital is 4950. If you have to file the tax return with 0 capital gains, then you should say your 54EC is 4950. Then only that can be achieved. But by investing 25 lakhs, if you have to achieve what assessee wants to achieve, the exemption I should claim is 4950, though I will invested only 25 lakhs. Now, effectively, what the department says, by putting 25 lakhs, in effect, The assessee is claiming an exemption of 49,50,000, which is virtually 200% of what is invested. That means he's trying to claim a weighted exemption. So which is never there. That's what it says. The assessee should not be allowed to claim beyond what he has invested. So that is a very interesting contention. So let's see what the judges have to say. So what the court has said, the deeming fiction under section 50C of the Act must be given as full effect, and the court should not allow to boggle the mind while giving the full effect of such fiction. And a very interesting point, they are also saying we don't oppose the proposition canvassed by the counsel of the assessee. The deeming fiction must be applied in relation to the situation which is created. They say they're basically conceding the fact, now since 50C only talks about section 48. So absolutely that argument is fantastic. But however, if we accept the assessee's contention, the automatic fallout of that will be the assessee will get more than what is invested. And of course, this will virtually defeat 50C, or 50C will automatically become redundant. Take our example, whatever be the number of stamp valuation, the assessee is going to come back and say, I've invested the actual consideration, therefore my tax becomes 0. So therefore, though they agreed with the contention of the assessee that deeming provisions must be restricted or confined to the section mentioned, but that interpretation results in an unexpected fallout of exemption more than what you've invested, making the enactment redundant. So law as consistently interpreted, the courts have always interpreted, law should be always given the life, it should not be killed as far as possible. So that's a very interesting point they made. Then some slightly different version of it, Gauli Mahadevappa with the reference to 54F. Again, just trying to take the same example here. 25 lakhs, 4 lakhs, 21 lakhs, 21 lakhs. The stamp valuation was 50 lakhs. So therefore, the capital gains is taken as 46 lakhs. Now, the assessee has made an investment of 30 lakhs. Now here, this is unlike 54, you see, we are trying to take it under 54F. Again, what the assessee's contention was simple. My actual consideration is 25 lakhs. I have already invested 30 lakhs. 54F says if the investment, the net consideration, if my actual investment exceeds the net consideration, entire capital gains should not be charged. So what should be the actual consideration? 54F defines the actual consideration as full value of consideration minus expenses. The issue is that what is full value of consideration? Is it the actual full value of consideration, or should it be taken on the base of 50C also? But assessee is simple. I put 25 lakhs actual consideration, I put the amount is more than that, I should not be paying tax. And this should be maintained even if 50C is invoked. So 50C is a deeming provision. But the department working is quite amazing. 25 lakhs, 50 lakhs, 50 lakhs is stamp valuation. Cost of acquisition or index cost 4 lakhs. Capital gains 46 lakhs. Now come the working. See, what the officer did here was, your consideration available is 25 lakhs. You have invested 30 lakhs. The 5 lakhs of your investment has not come from the sale of this land. You had only actual amount of only 25. That means if you have invested 30 lakhs, 5 lakhs would have come from somewhere else. It is not out of the sale of land. Therefore, he worked out the proportionate exemption as 25. That is, though I've invested 30, maximum you could have invested from the sale of land is only 25. Therefore, 25 divided by 15 to 46. Amount invested by net consideration to capital gains. So therefore, not only 50C was invoked for the purpose of denominator, but in the numerator, department refused to allow more than the consideration received by the assessee from the sale of land. Very interesting thing. Now, please understand, in Gauli Mahadevappa, the court did not went through this particular point. It has to only decide what should be the numerator. They never discussed or debated whether 50 lakhs in the denominator or actual consideration was never a discussion in Gauli Mahadev properties. The only issue was, can the assessee take the numerator as 30, which is the amount invested by him? That is what has been pressed by the assessee. Unfortunately, he did not question the denominator. It's only talking about the numerator. So therefore, the court observed the assessee should be allowed to invest from some other source also. It can be from savings or agricultural income. So long as invested from some other source also, that should also be considered for the purposes of 54F. That means what the court was holding here. The numerator can be 30, denominator is 50 into 46. Please understand, the denominator was never disputed. That was not part of it. Therefore, you cannot come back and say Gauli Mahadevappa, Karnataka High Court talked about, okay, you should take 50C value and all. That's not debated. It's only question of what is the numerator alone. So, however, so two cases we have seen slightly different. That means in a case where you have invested beyond 25 lakhs also, that should also be permitted. So I'll just keep, given the time fact, I'll just quickly go to, there are many cases like that. So the very interesting and the best of the decision, I really felt the fantastic analysis, Rajkumar Parashar. So I'll just skip all the assessee's contention down. I'll just go only the decision because we're running short of time. On perusal, it is clear that where cost of the new asset is not less than net consideration with respect to the original asset, the whole of such capital gains shall not be charged in section 48. The net consideration for the purpose of section 54 has been defined as the full value of consideration received or accruing as a result of transfer of the capital asset, as reduced by any expenditure wholly and excluding connection with such transfer. In other words, consideration which is actually received or accrued as a result of transfer has to be invested in new asset. The consideration as determined under 50C is not a consideration which has been received by or accrued as C. It is value which is deemed as full value of consideration for the limited purposes of section 48. So therefore here they say take only the actual consideration and you should not take the deemed consideration. So we have three different dimensions here. I will bring one more which is not part of any of the court rulings because 56 to 10 or the amount difference between the stamp valuation actual consideration was brought income from other sources only from assessment of 1415. Before assessment of 1415, there was no double taxation in respect of land or building and 50C. Only either 50C will apply or 56 to apply. Both did not have a simultaneous application. So therefore, the courts did not have an opportunity to discuss this particular point. So therefore, I'll just wind up the discussion with one slightly different dimension. These are the cases for and against. So now, just before that, we need to understand this section. So what is the section? Where the capital gains arises from the transfer of property subject to income from other sources, the cost of acquisition of such property shall be deemed to be the value taken into account for the purpose of clause 7 or 7A or 10. So essentially what they say, suppose 150 is a stamp valuation, 100 is the actual consideration, 150 minus 100, 50 will be taken as income from other sources. And my cost of acquisition of this asset, though I only paid 100, 49(4) says you should take the cost as 150, which is the value considered for the purpose of income from other sources. Now, take from the seller's point of view, he got actual consideration of 100, 150 is the stamp valuation. For him, the deemed consideration is 150. For the buyer, IOS is 50. Deemed cost is 150. Now, so what my contention here? Now, suppose if you have a situation where if the department says I should apply for 50C, I should apply the 50 consideration as a numerator, what should be the cost for the denominator? Let's assume I buy a property for 100. the stamp valuation of which is 150. We'll concede the fact that the department, okay, fine, it can choose 50C for the purpose of numerator. Now, I have purchased a property for 100, the stamp valuation of which is 150. I'm going to pay 50 as income from other sources. Once I pay 50 as income from other sources, 494 says I should take 150 as my cost. So that means for the buyer, for the purpose of 54F, I need to take the cost of reinvestment as 150. That is the only part. This has not been discussed in the various court for the simple reason, when the decision came, they are all prior to the assessment year 14-15. When IOS and capital gains both happened only from 14-15. So therefore, department cannot be selective. You can't say I will apply 50C for the numerator, but not for the denominator. Once I say deeming fiction of 50C should be applied for 54F, my view is that the deemed cost of 494 alone should be considered as investment for the purposes of claiming exemption under 54 or 54F. So this is one interesting part I thought. Because could have discussed with a lot of examples, but since probably we're running short of time, I'll just hand it over back to the moderator. And thank you very much for your patient hearing, and I thank both the chairman and the vice chairman direct tax committee for giving me this wonderful opportunity to interact with all of you. And thank you. Now over to the moderator.
Thank you, sir, for the wonderful, interesting session. In fact, and thanks, a big thank you to 1,120 odd participants today in this for the session and who are still holding on. We have with us Chairman of the Direct Tax Committee, CA Piyush S. Chajat. He's a chartered accountant in practice for the last 20 years. And he's also a son of the CASP Chajat, ex-president ICI, past president SCI. He specializes in direct and indirect taxes, appellate proceedings, and arbitration proceedings. He is a speaker on various topics on direct tax, a member of External Committee of Reserve Bank of India's Asset Reconstruction Committee, a vital contributor to WRC publication on Vivad Se Vishwas scheme, and he is also practicing litigation in direct tax as well as indirect tax. Very happy to have you with us, sir. Can I now request you to address the gathering?
Thank you very much, Subhashini. Thank you to Mr. T.G. Suresh for your wonderful deliberation on very important topic of capital gains. I know I was listening since last 15 minutes, and even on one particular judgment, there is so much controversy. I can understand how a session would have been. Very good evening to all the participants, and I'm very glad to be over here today. I could not join in the opening because we Direct Tax Committee is having simultaneously many programs, and I was attending a physical program today in small town of Latur, which is in state of Maharashtra. And there was a program wherein issues in tax audit was been discussed, and I had to address a gathering during the same time. So I thought I'll take this opportunity at the time of the closing when the speaker is done. But I'm sure this has been a very great enlightening session. I'm sure the way Sureshji has deliberated, it would be go a long way. And there would be a lot of issues still crop up after his discussion. I'm sure which the participants can raise, and it would be kept in, it would be responded by the speaker also. I would request if he's able to do that. I'm sure that will clarify a lot of doubts of the speaker. Subhashini, you have done a great job. My compliments to you, and thank you for being with us. Important things, obviously, I don't know my vice chairman has addressed, but I would like to just pick up 2 or 3 things very importantly, because tax audit season is coming. We all know we have already come out, a lot of messages are coming that whether we will coming with the guidance note of tax audit on revision 2024. So this year, what we have done is we have already come up with an implementation guide, which you would have received and which is now available on the website of btc@ici.in. This implementation guide covers the complete revision in Form 3CD, which was done in March 2024 by a notification of the Government of India, which includes the amendment made in 43B subclause H and the clause 22, which was amended based on that. So my request to you is please pursue that implementation guide, because this year where the committee had discussed and thought that we'll not revise the guidance. Right? The guidance note was revised in 2023 itself, and there was no amendment during that period of time. Any revision, if it could have happened after the budget. and the budget got approved on 17th of August, and the guidance note would have been delayed. So we thought, let us come with an implementation guide which can help the members in at least to address the revisions which have happened and the important considerations in regard to 43. So my sincere request to you would be, please do look into it. Please follow that. And I'm sure it will address a lot of your questions and queries which you might have in mind while certifying the Form 3CD would be resolved by now. Similarly, this year we came with a guidance note on audit report in Form 10B and 10BB charitable institutions. The implementation guide issued last year has been now converted. My request to you is please do look into that before certifying the Form 10B and 10BB. There are a lot of changes between implementation guide and guidance note, and therefore the document has been updated. A lot of responsibility statements in regard to the auditor has also been tried to be covered, like a management representation letters have been introduced in that particular guidance note, which will help you in taking representation when you are responding to the various clauses. So please do look into it. It will help in a long way. On the other aspects for DTC, as I believe this may be my last address unless we are able to plan some event on 2nd of September. Chairman and Vice Chairman, we both may not be available because the members are well aware that the term of the council is going to get over in February and the elections would be coming in 6th and 7th of December. So code of conduct would be there. We'll try to continue this program, obviously, because the office has to work for it, but the chairman and vice chairman may not be available. But if you have any queries, because the back office will be working, my request to you is if you have still questions in regard to tax audit, in regard to tax return filing, which will happen for the corporates, for the audit assessing, please do write to dtc@ici.in. We'll immediately take up, look into it and try to answer it. If it has to be forwarded to CBDT, if the representations have to be made to the government, we'll definitely do it. Our office will be working. We will be there at the back office. Each and every, I can assure you today, my vice chairman, and I can assure you that whatever queries, whatever questions, whatever representatives are being sent by you on our email of dtc@ici.in, each and every will be considered, discussed, tried by at the committee level, and if found appropriate, would be escalated to appropriate authority. And believe me, CBDT is listening to us. There have been instances this time when pre-budget memorandum, post-budget memorandum, lot of our suggestions were accepted. Lot of our representations have been already implemented. And on quarterly basis, we are discussing with them in regard to the representations which have not yet been accepted or implemented as what is the status. So I can assure at this stage, please do write to it. Please do not believe that the one single email will not be considered. Each and every single email can change for the way we are working today. Whatever you escalate to us will help more like 20,000 members. You may not be writing to us considering what will happen by one email. It's not that. Even a one email will be considered, which will have an impact across the membership at large, and therefore please do write to us. With this, thank you very much for being attentive, been over here for last 6 months over here. So thank you very much. Probably I am also bidding you goodbye again because I may not come on this platform again, maybe unless we plan some event on 2nd of September, which we are thinking it right now, but maybe it may be our last one. So thank you very much. Have a superb audit season, I would say, and super tax return filing season, and hope you get all the support over it. I could see Vice Chairman Kota sir, who is working very hard along with us. Obviously, he is also would be entering into the same boat which I would be entering into it. So thank you very much, everybody. Subhashini ji, over to you.
Thank you, sir. That was very, very wonderful listening to you, and such a vibrant address. In fact, like what a single email could do, actually, like it's really very supportive. And today, I think knowledge is the key to our profession, and it's very, very important that we all of us are doing the right things to uphold the prestige of our profession. Thank you so very much, sir. It was wonderful listening to you, and I'm sure like all your guidance notes, implementation guide are very, very useful, and I'm sure like all the members are taking benefit of that. Thank you, sir.
Thank you very much. Thank you. You can add. Thank you.
All the very best. And we had about 46 members communicating with us on, many compliments. Many people asked for the presentation with which TG sir already promised to share, and a few questions before the session, which was actually answered during the session, which was covered extensively in the session itself. I'm just taking up the questions just for like which will be relevant to reiterate the understanding and certain complicated matters as such. So The one is just an interesting question as to why the budget took a different date. So this is from Mr. Jayaraman Chennai. Good evening. Why the present budget 2024 had two dates, one for the deemed dividend concept on buyback of shares. TG sir?
So I think it's not only 2 days. So many dates are there.
Okay.
So
You got the question, sir. Yes, sir. That's it.
23rd July as a budget day, then you have 1st September for 147, then you have 1st October for many tedious. It's not 2 days. That is the most surprising part of it. There are too many dates in this budget. In fact, if all of us to write a CA examination, if there is one question is asked, when each of these provisions are applicable, I think all of us will fail.
That's wonderful. And you were mentioning about the compensation which is being received, like, if the government takes over, the date of the capital gains reporting will be the time when I actually receive the money. So there are a couple of questions around that, of course, a different thing altogether. Dear sir, in case of immovable property as per law, which date will be considered as date of acquisition? Date of booking the flat, or date of sale agreement between the buyer and the developer, or the date of registration in the name of the buyer? And one additional question on that, how to treat the sale of flat by the buyer before registration on the buyer name? So in one case, like booking is happening, registration is later. The other case, registration is earlier and the money comes later. So they have they need some clarification on the time of supply.
It is possible to take a stand if your date of booking and the thing is backed up with the actual registration later date. So there are a lot of decisions support that you can take from the booking date itself. As far as the registration is concerned, if that happens, you become the owner. The consideration is not the prerequisite. If the property is registered, automatically you are legal owner of the transaction. Whether you actually pay the consideration before that, it doesn't matter at all.
Thank you, sir. And the second one is ESOPs received by an NRI while being in employment in USA in a foreign country will be taxed for capital gain in India when he sells ESOP shares after returning to India when his status is RNOR, or sells his ESOP shares after becoming resident, ordinary resident. Again, regarding the time and how it will be taxable.
No, I think you're. I think you're looking at the watch, Naikana. So your questions are too fast for me to.
Okay, sir. No, the ESOP is received.
No, I understand
by
your program is 6:30 on tax audit. You have to travel there. So anyway, so
I'll be slow. This is regarding a NRI who receives the ESOP when he is overseas, let's say like US. But like he sells the ESOP after he returns to India. And there are two parts to this question. One is like resident, ordinary resident, and resident, not ordinary resident. In the two scenarios, if he sells the shares, then what happens is their question.
oh, if the shares are, is the company incorporated in India or what?
Outside India must be, I assume.
Say if the company if the company is incorporated outside India, obviously if it's a non-resident, so the question of taxing the capital gains possibly does not arise because of the fact that the situs is not in India. So, but again, if you are R&R, the global income becomes taxed.
Right. And one is on the TDS. So any property transferred by the non-resident, then what is the rate of TDS? This is like 23rd July, prior and after. People have a lot of confusion. So I thought this question will be relevant.
See, as far as the non-resident, we already mentioned. So again, as far as the TDS rate is concerned, so one is like, the question is, though 195 talks about the sum chargeable to tax, the question is who has to decide the sum chargeable tax will always become the question. So one is buyer on a safer side would like to deduct TDS on the entire consideration unless you produce a lower deduction certificate or certificate from the assessing officer under 194(2) to protect this interest. However, if the buyer is possibly, if he feels okay, I will also interpret the section as some chargeable tax. You give my working, I'll satisfy myself, and this is the income on which he can apply the tax rate. As already mentioned, as far as the non-residents are concerned, the option of choosing does not arise for them. So for them, there is no option. If it is before 23rd July 2024, he will come under the old capital gains regime. If it's after 23rd, he comes under the new tax regime. Question is, it will be either 12.5% on the entire amount or 20% of the entire amount, depending on the date of sale. I don't think any buyer, because of the fact that you would not like to take a chance unless you give an 195(2) or 197 certificate. Buyer would like to protect himself. So therefore, for the non-resident, On the entire amount, it could be 20 or 12.5, depending upon which date he sold the asset.
And you already mentioned that the loss which occurs, like the example which you gave, like 70, 50, and the laws which we actually incur, that cannot be carried forward. Now, here the question is, can I set off in this year?
No, the question of set off, see, the loss itself is not computed. What I'm trying to mention was, see, the computation section has not been changed at all. So computation today is that consideration minus cost, that's all. The indexation is not available from 23rd July 2024. It's only the tax rate working. They're giving they say that excess shall be ignored. I won't say there's an option here, because option means if you're not claimed, the department can proceed. There is no option. Even for the department, there is no option. So essentially, while computing the tax rate, the indexation benefit will be considered, and based on the indexation, if the tax rate is lesser than without indexation, that excess tax should be ignored. So therefore, computation mechanism from 23rd July 2024 is always going to be without indexation. Once there is no capital loss, where is the question of setting off? So when there is no loss, first of all, in computation itself, you may not get the loss. Unless
the break-even index which you gave.
Yeah, unless your cost itself is more than the consideration, today you will not get the loss at all. So that means if to get a loss, you have to sell below the cost. That's the only possibility. Otherwise, you will not get the loss at all. No question of set off or carry forward.
Thank you for that. And there's one thing again on the consideration received. So the SSE has transferred the unlisted shares, but he has not received the money yet. So can he actually postpone the transaction, or probably report the transaction as and when he receives the money?
Well, see, it's see, the method of accounting as per section 145 is not relevant for salary or house property or capital gains. Only in business income or income from other sources, you can, depending upon the method of accounting followed, you can offer the income on accrual cash basis. So you have to go as per section 45 only, where the capital gains gets triggered at the year of transfer. So therefore, there is no requirement in section 45(1) that you should be in actual receipt of consideration. So therefore, whether you receive the consideration or not, once you have transferred the shares, capital gains liability automatically gets triggered. Method of accounting has got no relevance when it comes to question of capital gains.
Also, thank you. And the last question, whether the indexation is available for the capital assets in case of conversion into stock in trade before 23rd July 24, but sold after 23rd July.
Yeah, definitely it's available. That's what I was mentioning, because the section says that for transfer which takes place on after 23rd July 2024, indexation benefit is not available. So in the case of conversion of capital stock in trade, the date of transfer, the date of conversion. So therefore, the transfer is complete before 23rd July 2024. 45(2) only postpones the year of taxation of capital gains. Assuming I said on 1/4/2025, it is a capital gains which occurred before 23rd July 2024, which has been taxed in assessment at 26/27. So what 48 proviso says, it only talks about, it is not talking about in which year capital gains liability is triggered. It only talks about in which date the transfer took place. As per 247 clause 4, transfer happens on the date of conversion. If that is before 23rd July 2024, you are eligible to claim the benefit of indexation, even if the capital gain happens in assessment at 29/30 or 30/31. Anywhere you can claim.
Wonderful, sir. Thank you so very much. I think the topic said interesting issues in capital gains. I think you covered all the issues in capital gains and made it very, very interesting. And thank the Direct Tax Committee, the chairman, vice chairman, and the team for making this very, very vibrant every Thursday. Knowledge sharing and all is wonderful. And we have about 1,120 plus audience who are viewing this, who are getting benefited by the knowledge sharing initiative of this committee. So thank you, ladies and gentlemen, for joining us for this session. And thank you once again, sir, to you for taking time out. And when in your introduction, you said you learned by making presentation, and I'm sure this extensive time you've spent and extensive research you've done in making such a complicated subject into a capsule kind of a thing with beautiful illustrations, where there were many requests for the presentation actually. So that is a result of your wonderful presentation. Yeah. Thank you all. Thank you all for joining us.
Thank you.
Thank you, Zo.